Good afternoon, everyone, and welcome to another one of Avant-Garde Trading's free educational trading webinars. We are thrilled to welcome OIC instructor Ken Keating. He is back with us to talk to you all about premium income, cash secured puts, and the wheel strategy. Ken's going to cover a lot of information in this webinar, some of which main bullet points are going to cover the mechanics of cash secured puts, strike selection, expiration scenarios and assignment, and an overview of the wheel strategy. So we have a jam-packed webinar full of great information. We are thrilled to welcome Ken here with us. Ken, are you there?
I am, Natalie. Can you hear me?
Yes, I can. Thank you so much for taking the time to join us this afternoon and put on this presentation. We are looking forward to it.
Absolutely. Would you like me to go ahead and share the screen?
Please, whenever you're ready, you can go ahead and share your screen, put your presentation front and center, and I will remind everyone who is live in the Zoom room, if you have questions during the presentation, please type them into the chat box, and I'll get those to Ken to address at the end of the presentation. And I can see your title slide. It looks great, so feel free to begin when you are ready.
Perfect. Well, thank you, Natalie, and thank you, everyone, for joining us today and taking time out of your busy schedules to be with us for this webinar presentation. So as Natalie mentioned, my name is Ken Keating. I'm a principal of investor in education at Options Clearing Corporation, OCC, as well as an Options Industry Council instructor. I've given many presentations to AGT over the years. So if you don't know my background, I'll just give you a quick background on myself. So I started trading options professionally in the mid-90s on the floor of the Pacific Coast Options Exchange, and I worked for one of the largest privately held market making firms at the time. So I traded out in San Francisco. I then moved to Chicago, where I worked as a floor market maker and a floor specialist for that very same firm on the Chicago Board of Options Exchange, trading professionally for my firm. I then moved back to San Francisco, where I ran risk management for the entire firm, exact same firm. Left after that, ran a prop desk for the exact same firm upstairs, trading a large book of off-floor options. Did that for a couple of years, ended up going back to the floor, working as a floor market maker and a floor specialist. After leaving that company, after about 15 years, I ended up working for a capital management firm where I traded a very large book of options off-floor. And I've also worked for myself as a sole proprietor, trading options electronically, as well as a derivatives and equities analyst for a pair of startups. So currently I work at OCC, helping individuals such as yourselves to better understand both the risks and the benefits of exchange-listed options. I've been at OCC for about 6 years now. Currently I work in the investor education department, as I said, helping individual investors such as yourselves to better understand both the risks and the benefits of exchange-listed options. So speaking of the risks and benefits, we always have to mention our disclaimer to keep all the lawyers at OCC happy. So options do involve risks and are not for everyone. So anyone considering trading options should thoroughly read and understand the characteristics and risks of standardized options, also known as the ODD or the Options Disclosure Document, which you can obtain by visiting us at optionseducation.org to download a free digital copy. Or if you prefer a physical copy, you can always reach out to your broker or any exchange on which options are traded. In order to simplify the calculations used today, commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies that I discuss here today are strictly for illustrative and educational purposes. Okay, one last slide for all the lawyers at OCC. These are all the trademarks and logos you will see throughout the presentation, and these are owned outright by OCC. A little bit about OCC and OIC. Who exactly is OCC? Well, OCC is the Options Clearing Corporation, as the world's largest equity derivatives clearing house for exchange-listed options in the United States, as well as the Foundation for Secure Markets. So OCC has been clearing and settling options since 1973, when options first started trading in Chicago on the Chicago Board of Options Exchange over 50 years ago. OIC started out as a collective in 1992 as we're effectively the education arm of OCC. So what we do is we provide free and unbiased options education to the industry. Our educational offering is completely free of charge, and we can do this because we are fully funded by our parent company, OCC. So we don't sell you courses, we don't sell you monthly subscriptions. All you have to do is you go to our website. That's where we house all of our educational material, optionseducation.org. There you'll find online courses, you will find podcasts, videos, and additional webinars just about on any topic that you can think of regarding the options product. If you ever have questions regarding the product, you can always reach out to us. Send us emails at options@theocc.com. I work on a desk with 3 other very talented individuals, and collectively we have well over 100 years of trading and brokerage experience on our team. We have real world experience. We've been through a lot, traded through a lot of different markets. Once again, we can't give you advice because we're not registered advisors, but we can talk to you about the product in detail. We can talk to you about strategies. Also, how corporate action may impact you if you if a corporate action if you come across one. Because if you trade options long enough, at some point you will be impacted by some type of corporate action, whether it's a merger or a stock split, a forward split, a reverse split, a special dividend. These all affect option contracts differently. And if you ever have a question regarding how corporate action impacts your options, please reach out to us, and we are always more than happy to help you out. Okay, this is one of my favorite charts. This is options volume over the last 25 plus years. And once again, the trajectory and volume over the last 6 years has just been phenomenal. So the last 5 years alone, we had record years. Last year was we cleared and settled 12.2 billion contracts. And you contrast that, when I left the floor back in 2000, we were clearing and settling about 2 million contracts on a daily basis, which at the time was a lot of volume. And then the internet bubble popped right around 2001. We were trading about 3 million contracts on a daily basis. You contrast that today, where we're averaging 58 million contracts on a daily basis. So, this snapshot was taken back in June, but if we stay on this average growth trajectory, we're probably going to be clearing and settling northwards of 14 billion contracts, which would be another record year for the industry. So, what that tells me is not only are more and more people trading options, but they're actually trading them more frequently. And that just points to the importance of options education, because while options aren't overly complicated, there is a little learning curve that it takes to understand some of the nuances with the product. And hopefully with this presentation, I'll make one part of that this particular strategy a little more easier for you to understand. Okay, so let's get into it. So today I'm going to be talking really about 2 different strategies. Okay, we're going to be talking about the cash secured put, and then at the end we're going to be talking about the wheel, which simply is the combination of a cash secured put and a covered call. But we're going to first talk about the mechanics of a cash secured put, the motivations, why somebody might put on a cash secured put. We'll examine strike selection, because strike selection is always an important aspect of any option strategy when you're looking to put something on. We'll be looking at expiration scenarios and particular assignment scenarios should that happen at expiration. So once we get into the cash secure put, then we will come around and we will do an overview of the wheel strategy. And both of these strategies are income generating strategies. And this is why investors love doing covered calls, cash secured puts, and the wheel, because these are income generating strategies. And once again, these strategies aren't for everyone. If this is the type of, and we'll walk through why somebody might do these, but if they fit your investment style and risk tolerance, this is something you might want to consider. Once again, Q&A will be conducted at the end of the presentation. At the end of the presentation, which will probably be about 45 to 50 minutes, I'll bring back Natalie and we will entertain any and all of your questions. And just so you know, if for whatever reason we run out of time and there are questions remaining, Natalie can shoot those to me, and I'd be happy to answer your questions by email after the event. Okay, so with that out of the way, let's get started. Cash secured put mechanics, okay? The basics of short puts. So remember that when you're trading options. There's two parties to a trade. There's the buyer and the seller. So anybody who buys an option is buying the right, but not the obligation to either buy 100 shares of the underlying stock in the case of calls or sell 100 shares of the underlying stock in the case of puts. The person who sells the buyer the contract, okay, is the put seller or the call seller and is obligated to deliver the asset in the case of calls or, take delivery of the asset in the case of puts should they get assigned, okay? And in return for taking on this obligation, they receive premium for whatever the cost of the option that it's trading for, okay? So buyers have rights, sellers have obligations. So typically, somebody who puts on a cash secured put, a put writer is typically neutral to moderately bullish on the securities that they're looking at. And they're also expecting maybe the implied volatility for the options is high. In other words, the option prices are expensive and they're looking to take advantage of that and maybe sell a cash secured put. So remember that cash secured puts are a great strategy for somebody who is, once again, neutral to moderately bullish. Maybe you're sitting on a lot of cash, you haven't invested in the market, and the market took off, or a particular stock took off. You were maybe, let's just say you were looking to buy a stock at 90, it ran to 100. You don't want to chase it. Nobody should chase stocks, but you'd be comfortable buying maybe some shares at 90 on a pullback. Well, a cash secured put affords you that opportunity. And in return, you're also taking in income. Okay. It's kind of like selling protection to somebody else. Okay. Or selling insurance. Okay. I don't know how many other businesses where you can actually become the insurance company, but this is actually one of those instances where you actually get to become the insurance company and sell shares. Sell puts to somebody else, take in that premium income. Now you're also obligated to buy those shares at that strike price should the exerciser or the person who holds the put decide to exercise. So it really only works for people who are looking to own shares at a particular level, buy stock at a level lower than where the market is currently trading. Okay, so it's kind of like a way to get paid to wait for stocks to get down to a level that you're comfortable buying them at. Okay, now keep in mind there's not a lot of protection to the downside because if you get assigned on a put, you have risk all the way from your strike price all the way down to, or your break even price all the way down to zero. Okay, so the risk in any cash secured put strategy is in the potentially long stock position that you might have should you get assigned. Okay. So once again, this is a strategy that many professional investors use. I know that Warren Buffett is an avid user of options in the market, both on indexes and individual stocks. At one point in time, like Warren Buffett used to come into the options market and sell thousands of out of the money puts in Coca-Cola because he loved Coca-Cola stock. And if he got assigned on those puts, he was very happy because he was able to buy a block of stock at a level he was very comfortable owning it at. And if the stock never got down to that level, well, he kept all the premium that he received when he sold those puts. So for him, it's kind of a win-win. Okay. Now, once again, this really only works for, selling cash secured puts. It should only be done on stocks you don't mind owning in the first place. Because if you're selling cash secured puts as an income generating strategy on stocks you don't really want to own, well, now you're just gambling. Okay. And people do use the options market to gamble. I'm not recommending that you do, but people do. But this is really only a strategy that you should consider if on stocks that you don't really mind owning in the first place. Okay, so what is a cash secured put? Okay, it's a combination of a short put with an appropriate amount of cash deposited to cover the potential assignment obligation. In other words, you sell a put and then you deposit an amount of cash that would cover your assignment obligation, and you keep that in an account should you get assigned. Okay, so typically the cash secured put writer is either bullish or maybe even short-term bearish, hoping that maybe the stock dips, they get assigned, and then it's going to pop after that. Okay. Another way to think about it is it's kind of like a GTC order that you get paid to place. Okay. So what's a GTC order? Well, a GTC order is a good till cancel order, and this is a free order that you can place with your broker. And using the example I used earlier, if stock's trading, you wanted to buy shares at 90, it ran from 90 up to 100, you don't want to chase it, but you'd be willing to buy shares at 90. Well, you can put a GTC order in with your broker to buy those shares at 90, good till cancel. It just sits there. It's a resting limit order to buy those shares at 90 should the shares dip. If the shares dip and hit your limit, you may buy those shares, you may not. Once again, it becomes a limit order to buy shares at 90, okay? In the case of a cash secured put, it's you're selling somebody else the right to sell shares at 90. You take on the obligation to buy shares at 90. If you get assigned, you're gonna have to, pay your strike price times 100. In other words, come up with $9,000 less whatever premium you took in to own those shares. But you're also going to take in that premium income. So when you sell options, that option premium that you sell is yours to keep. Okay. But keep in mind that anytime we sell options, the most we can make is what we sold those options for. Okay. So, where buyers of options have kind of like defined risk and undefined reward, sellers of options have defined reward and undefined risk. So anytime you are selling cash secured puts, okay, your break-even price on that stock, should you get assigned, is going to be reduced by the premium that you receive. So let's just say we sold that 90 level put, stock's trading 100, and let's just say we sold it for $5 with a couple months to go. And should we get assigned, if all of a sudden the stock dips below 90 by expiration, maybe it closes at 89, okay? Well, if we do nothing, we're going to get assigned. Somebody's going to exercise that put. They're going to deliver. We're going to be obligated to buy shares at 90, even though it's trading for 89. Okay. We're going to pay our strike price times 100 or $9,000. But remember, we took in $5 from the sale of that put. Okay. So our effective break-even price isn't 90, it's 85. Okay. We actually own shares technically from 85 because that premium income reduced our break-even price. Even though technically we were buying shares at 90, we took in $5 that's ours to keep. That reduces our break-even price down to 85. So we'll look at some examples of that. So some investors will sell cash secured puts at different intervals, sometimes weekly, sometimes monthly. Maybe there's a particular stock that you want to buy 500 shares of. You could sell various strikes in cash secured puts at different months to kind of leg into a particular position. You don't have to sell, 5 puts at one strike. Okay. You can kind of strategically kind of build a position by picking different strikes. The strike price obviously is at this price at which the shares can potentially be assigned. Okay. And once again, the days to expiration can always be tailored to your particular forecast and risk tolerance as an individual investor. There's no right or wrong answer about which strikes to target. Okay, once again, this is going to be based on the price you're getting for the puts, your overall forecast on the security, and obviously your risk tolerance. And anytime you're trading cash secured puts, assignment is always a possibility if you're trading American style options. American style options can be exercised at any time on or before expiration. But keep in mind that if we get a sign on a cash secured put, that should be a welcome event, right? Because, if shares are trading 100, we sold the 90 level put, we're happy to buy shares at 90, okay? If we get a sign, we should still be happy to buy shares at 90 on a pullback unless something changes, of course. Okay, what are some of the risks of cash secured puts? Well, shares might not just dip, but they could plummet. Okay, so keep in mind that the risk lies in that potentially long stock position should you get assigned on that short put. Okay, so declining share prices could lead to higher put prices, making closing that position a losing proposition. Like all of a sudden, let's just say, stock blew through 90 and now it's trading 80, and now maybe you're not so bullish. Maybe you don't want to even own shares. So you just go into the open market, you're going to buy back that put at a loss. Yes, it'll be a loss, but you're not going to, as long as you close out that put before expiration, technically you shouldn't get, you should alleviate any kind of unwanted assignment, okay? But you might be purchasing those puts back at a loss. Also, keep in mind that as share prices decline, implied volatility, the options goes higher. So once again, options trade based on the supply and demand for options. When the market rolls over and sells off, people get nervous and option prices expand. Okay, as those option prices expand, implied volatility expands because more and more people are reaching for protection, or they're reaching for puts on the downside. They're reaching for calls to play a pullback on the upside. All that natural demand for options raises the price of options, thus the implied volatility. So an increase in implied volatility is going to exacerbate a short put position. In other words, making those options more expensive to buy back should you need to buy them back. In the event of a bankruptcy, stocks do go into bankruptcy. An investor may be forced to buy their strike price. If you get assigned, pay your strike price times 100 and receive nothing. Okay, so what happens in a bankruptcy, if a bankruptcy court comes out and decides that they're going to cancel the shares because they're worthless, okay, you have risk all the way down to zero. Okay, so if we get assigned on that 90 level put, theoretically, you have risk from 90, or in this case, 85, because you sold the put for $5. But either way, you have risk from your break-even price all the way down to zero, which you do have in any stock that you hold. But just keep in mind, that's the worst case scenario. Also, if the share prices rise, let's just say maybe stock at expiration closes at 91, okay, you may never get assigned on that put. Okay, you're still going to keep that $5, for selling that put, but you're never going to, if you don't get assigned, you're not going to own those shares. Now, like, let's just say, for example, stock closed at 91, its expiration, you don't get assigned, okay? You could decide to sell another cash secured put, take in some more additional income for another, at another strike. Or you could just, you've got $5 in your pocket, you could just go out and buy the shares outright, pay $91 on Monday morning for them, and you're effectively long stock from 87, right? Because you're, I'm sorry, 86, because you took in that $5 initially. So remember that $5 is yours to keep. But once again, you'll just have to make a decision on what to do if you don't get assigned on Monday, or maybe even expiration Friday, based on wherever the stock is going to close. All right, so let's look at a hypothetical example. Okay, so here is a stock. It's trading for 100, and maybe we wanted to buy it at 95. Stock ran, and now it's trading 100. So we look at our options chain, and we see that we can sell the August 95 put for $3. Okay, so by doing so, we're once again neutral to moderately bullish. We don't want to buy shares pay $100 per share, but we'd be willing to buy some shares for 95. Okay. We're looking for premium income because this is an income generating strategy, and our target is our intention is to buy shares lower than where they are currently trading. In this case, 5% lower than where they are currently trading. So we sell this 95 level put for $3. Okay. We're going to have to put cash on hand with our broker of 9,200. Okay. Because remember, that's the cash secured portion of the put. Remember, we have to deposit $9,500 with our broker, but we took in $3 for the sale of the put. So in fact, we're really only going to have to deposit $9,200 with our broker for each put we sell. Our maximum gain, okay, is going to be that $3 that we took in for the option, which actually is $300, because remember, anytime you see a price in the options market, it's per share, and every contract is the right to buy or sell 100 shares. So you have to multiply the price that you buy or sell your options for by 100 to get the true price. So that's why when we sell an option for $3, we actually take in 300. Okay, so that's the maximum gain should we not get assigned on this position. Our maximum risk is from 92. It's 9,200, right? Our break-even price is going to be $92. And we have risk from 92 all the way down to zero should the shares fall apart. It's going to take $9,200 in capital requirement. And once again, our break even is the strike price that we sold minus the premium that we took in We do all the math, it gets us to 92. Our break even on this position is 92. So if the shares finish at 92 at expiration, we're neither going to make money nor lose money. Okay, our 95 level put is going to be worth exactly $3. If we get assigned, we're going to be essentially long shares from 95, but remember we took in that $3, so effectively we're just going to be long stock from 92. Okay, with all the risks on Monday morning. If the stock opens on Monday morning up, we're going to make money. Should we get assigned, if the stock moves lower on Monday morning, we're going to have an unrealized loss on our hands. And once again, this doesn't take into effect any kind of transaction costs or commissions that you might pay. Okay, so let's look at the exact same position in graph form, because sometimes it's easier to visualize this in graph form. I'm personally a more visually oriented person, so it's a little easier for me to wrap my head around when I look at it in graph form. But here is a graph where the yellow line here is just buying 100 shares of stock outright. Obviously, it's pretty straightforward. The stock goes up, we're going to make money. The stock goes down, we're going to lose money. But the selling the August 95 put for $3, this is what the graph looks like. Okay, we have a break-even price of 92. The most we can make is if the stock closes at 95 or above on expiration, we're going to make that $3. We're not going to get assigned. If the stock closes below 95 and we do nothing, we're going to be assigned. We're going to be long shares from 95, but remember we took in $3 for the option, so effectively our break-even price is 92. So at expiration, if the stock is above 92 at expiration, we're theoretically going to have an unrealized profit. If the stock shares are below 92 at expiration, we're going to have an unrealized loss on our hands. Okay, so once again, the maximum gain in this position is if we get assigned, our effective long price is 92. So technically, we have theoretically unlimited upside potential because there's no limit to how high a stock can technically trade. Our maximum gain, if we don't get assigned, is the premium that we took in, that $3. So that's our maximum gain if we don't get assigned, the 300. And obviously our maximum loss is our break-even price, 92, all the way down to zero. In this case, $9,200, which is the money that we pledged to collateralize the position when we established it. Okay, now let's look at an alternative to the bull put spread, because you might ask yourself, well, yeah, I wouldn't mind buying shares at 90, but what if all of a sudden some news comes out and shares go to 80? Okay, I want to kind of protect myself. Well, some investors might choose to put on what's known as a bull put spread. Okay, so once again, a bull put spread is a position that's also neutral to moderately bullish. Okay, you put this on because you're looking for premium income. You're ideally looking for share prices to rise, but it affords you a little more protection than just selling cash secured puts. Okay, so selling cash secured puts offers no downside protection except for the premium that you receive. If you buy shares outright, that can be capital intensive and doesn't provide you any protection if the shares plummet. To offset the risks of a short put, okay, the put writer can consider purchasing a further out of the money put for protection to limit their downside risk. So let's look at this. So we have a fictitious stock, Bubble. It's a fictitious soft drink maker, and it's trading for 120 a share. And rather than commit $12,000 to buy 100 shares, they're looking to sell cash secured puts. So they look to sell the 115 level put, which obligates the investor to buy the shares upon assignment at 115. But at the same time, they want some protection if the shares fall apart. Okay, so at the same time, they can buy the out of the money 110 strike put. Okay, so they're going to, what they would do is they would sell the 115 put, buy the 110 put. This would be, if you had this position on, you'd be short. As a trader would say, you're short the 115, 110 put spread. Okay. So by being long the 110 put, it affords you some downside protection should the shares fall in price. So let's just say with 45 days to go, stock trading 120. In this example, you could sell the 115 put for $2. you could buy the 110 put for 70 cents. That's a net credit of $1.30 or 130 per spread. So once again, that credit is yours to keep. That's you put it in your pocket, but that's the most you can make on this position. So what's the maximum gain? The 130 credit that we took in. Our maximum risk is the difference in strike, 115 minus 10, that's $5, less the credit that we took in, $1.30. So what's $5 minus $1.30? It's $3.70. Okay, so our maximum risk is $3.70. How much margin do we have to put up? Well, it may vary, but technically you really only have to put up what the potential overall maximum loss would be in this position, which is in this case, 370 per spread. Okay, you can kind of think of it this way as you're risking 130. You're risking 370 to make 130. Okay, your break even at expiration is if the stock is at 113.70 or higher. Okay, in other words, if the stock closes at 113.70, you're going to get a sign on this 115 put. You're going to be long shares from 115, but remember you took in $1.30. Okay, so 115 minus $1.30, that's 113.70. Okay, that's where you break even. If the shares close at 113.70 on expiration, yes, and you do nothing, you're going to get a sign. These puts will get exercised. Your 110 puts will expire worthless, and you will effectively be long stock at roughly 113.70. Okay, if the shares close below 113.70, you'll be sitting on an unrealized loss. If the shares close above 113.70, you'll be sitting on an unrealized gain. Okay, so here is it's called a bull put spread because obviously you want the shares to go higher, because if the shares finish higher, let's say the shares finish at 116, well, both of these puts would theoretically expire worthless and you would keep the full $1.30 credit that you sold the spread for, okay? So here we go. If the shares finish above 115, both legs expire, you achieve your maximum profit. There is no stock position. If the shares finish anywhere between 110 and 115 and you do nothing, you're probably going to get a sign on this short 115 put, meaning you're going to be effectively long from your break-even price of 113.70, and a long position would result. If the shares finish below 110, okay, you will get a sign on this 115 put. You're probably going to exercise this 110 put. You're going to lose $5 on this put spread, but you took in $1.30 when you sold it. So once again, that's going to result in a maximum loss of $3.70. But the beauty is, if all of a sudden, stock trades down to 100, okay, and if you just had the cash secured put on, you'd be down $13.70 because your break even's 113.70. In this position, in other words, you'd lose $1,370. In this case, you can only lose 370 because you have this long put here as protection. You're not going to make as much credit, okay, on the overall position, but you do have protection at the 110 level. So once again, no right or wrong answer, but this is another kind of like a defined risk way. It's called a credit spread, and it allows investors to, whether you're bullish or bearish, if you were bearish, you do a bear call spread. And, in this case, we're doing a bull put spread because we're bullish. But credit spreads are just kind of a creative way to allow you to sell option premium while mitigating or while defining your risk. Okay, so strike price selection. Okay, strike price selection is always going to be dependent on your individual forecast and risk tolerance. Okay, and it's going to be a balance between your overall forecast, your risk tolerance, and keep in mind that when we're talking about puts, the strike price you decide to select is going to determine your buy-in price upon assignment. Okay, so let's just say we have $100 stock's trading 100, 45 days to go to expiration, and we see various put strikes. Okay, we have the 95 level put all the way up to the 105. The 105 and 102.5 are in the money. The 100 put is exactly at the money. The out of the money puts, the 97.5s and the 95s, are out of the money. And as you can see, obviously, the higher you go in strike, the more premium you're taking in for those puts, okay? But keep in mind that, the more in the money puts that you sell, if you sell an in the money put, some people will do that, but you're going to take in more premium, but the price that you're going to be effectively long those shares is going to be higher. And if you, should you get assigned. So let's take a look at that. So here we go. Here's the buy-in price if you get assigned at these different levels of premium. Okay, so if you sell the 105 put, you're selling, you're taking on the obligation to buy shares at 105, even though they're trading for 100, but you're taking in $7.80. Okay, so your buy-in price would be, should you get assigned, is 97.20. Okay, in other words, it's 105 minus the 780, that gets you to 97.20. As you go down in strike put, in strike for the puts, you see that your potential buy-in price is going to be lower and lower as you go down in strike. So you have to kind of like figure out what level you're comfortable buying it at. Okay, kind of like what strike am I comfortable owning the shares at? And then, weigh that against the premium that you're receiving. Because remember that the premium that you receive is going to lower your effective break-even price. If I sell these 100 level puts with the stock trading 100 for 490 and I get assigned on them, well, I know that I'm going to be long shares at expiration if I get assigned at 95.10. Okay, if I'm comfortable being long shares from 95.10, maybe I want to target that 100 put. Okay, so once again, taking that the premium that you're going to receive for those puts, subtracting it from the strike price to get your overall break even, and seeing if you're comfortable buying those shares at that level. Okay, this is the premium retained if the puts are unassigned. Okay, so obviously, if all of a sudden the stock rallies and closes at 106 at expiration, you're not going to get assigned. You're going to keep this full $7.80. That's yours to keep. But as you go down further and further in strike, these prices tend to be less. Okay, so once again, it's going to be a combination of your overall forecast, your risk tolerance, also the premium levels, and how you measure the premium levels is looking at the implied volatility of the options. I can't get into a deep discussion of implied volatility, but maybe the next webinar I'll get into implied volatility, but it's a really important aspect of trading options. It allows you to measure how either expensive or cheap those option prices are in the marketplace. Okay, so what happens next at expiration? Well, if the shares are down below our short put strike at expiration, it's likely that we're going to get assigned. Okay, so upon assignment, we're going to purchase our shares at our strike price, with the effective share price being our strike price minus the premium received. And now you're going to have a long position at that particular break-even price. If the stock is up, okay, well, it's possible that we're not going to get assigned, okay, but we're still going to keep 100% of that premium that we took in. So remember that anytime we sell options, that premium is ours to keep. So in this case, the stock is up. We didn't get assigned, but we still got paid for selling those puts. And in this case, if the shares are unchanged, okay, it's similar to if shares rise, okay, but once again, in this case, if shares finish right at our strike, okay, we may or may not get assigned. If we don't get assigned, we're going to keep 100% of the premium that we collected. If we do get assigned, we're going to basically be long stock on Monday morning from our new break-even price, okay? So, oftentimes to alleviate any kind of, what ifs at expiration, if we're short the 100 level put at expiration and stock closes right at expiration, just say, we sold it for $4.80, that's ours to keep. But if all of a sudden it's closing at 100, we don't know if we're going to get assigned or not. Okay, we could just buy back that short put for maybe a few pennies. Okay, by buying back that short put, it mitigates any kind of potential assignment, and then we can reevaluate on Monday morning. Okay, maybe we want to sell another cash secured put and start the process all over again, Or maybe we're happy to take that, $4.80 or whatever we sold that put for. It's going to lower our cost, and we just buy the shares, manually on Monday morning. We could do that as well. Okay, so once again, there's no right or wrong answer. It's all going to be completely dependent on your individual forecast and risk tolerance. Okay, now let's talk about the wheel strategy. Okay, so that's the cash secured put by itself. Now, the wheel strategy combines a cash secured put and a covered call. Okay, that's why it's called a wheel. Now, it doesn't matter. You can start with a cash secured put. You could start with a covered call. Oftentimes investors will sell covered calls, in other words, an out of the money or an at the money call against stocks they already own, also as an income generating strategy. If you get assigned on those calls, you're going to have a bunch of cash in your account. Now you could turn around and sell a cash secured put, take in additional income, and potentially buy those shares at a lower price. So it doesn't really matter whether you start with a covered call or the cash secured put, but the idea is you bounce between the two strategies, ideally kind of buying low, selling high over time and creating an income stream. Okay. So in the case of a covered call, if you become assigned, you would sell cash secured puts against that position, take in additional income. If the cash secured put gets assigned and you're going to be long shares, now you can take those long shares and sell a covered call against it, maybe an at the money or out of the money call against it to take in additional income. And once again, the intent is to generate a consistent flow of premium income through the sale of the options on these particular stocks. So let's look at another hypothetical example. Okay, so an investor is long 100 shares of OICX and decides to sell a covered call in hopes of generating premium income. And once again, a covered call is also a neutral to moderately bullish option strategy. So there are long shares, let's say from 95, and decide to sell the 45-day 100 level call at $5. Okay, we'll fast forward to expiration. Shares close at 102, and the investor gets assigned, okay, on the short call. They're going to collect their strike price times 100, in this case, $10,000, and you will have to deliver that 100 shares of stock that you bought for 95. But remember, you bought it for 95, you're selling it at 100, you're making $5 on the stock purchase, but you're also keeping $5 in premium, okay? So net, that's $1,000 profit in this case, okay? So yeah, so basically you bought shares for 95, you sold them at 100, but you took in $5, okay? So the closing position value is $10,500 for $1,000 profit overall, not including commissions. Now, you're going to wake up with cash in your account on Monday morning. Now you can start the wheel strategy, okay? You have $10,500 to invest, $1,000 more than you had initially, and you choose to sell a cash secured put. Maybe stocks, it closes at 102, and we look at our options chain and we see that we can sell 45 days out the 95 level put, okay, because we're happy to buy shares back at 95 on a pullback. We can sell those puts for $4.70, okay? So we have to deposit $9,030 to cover the potential assignment. Remember, 95 minus 470, that's $90.30. That's why we have to securitize this position with $9,030, okay? Now we have the cash secured put on, okay? If shares close at 93 at expiration, okay, and we do nothing, we're going to be assigned on this short put, okay? In this case, now we're going to pay our strike price times 100 or $9,500, and we're going to receive shares of stock. But remember, we sold this put for $4.70. So if we get assigned at 95, our effective break-even price is $90.30. So we're going to be sitting technically on a $2.70 unrealized gain in this particular scenario. And now we have an open position. Now we're basically long stock again, obviously with the downside risk. And now we can rinse and repeat. Now we can look to sell another covered call against it, okay? So, once again, I know that sounds very simple, but, things do go wrong. You know, stock, you could get assigned at 95 in this case, and the stock could go to 90 or 85 or lower. That's the risk in this. In any covered call or a cash secured put situation, the risk lies in the long stock position. So this is really only works on stocks that you don't mind owning in the first place. And obviously, you know, market dynamics change, forecasts change, risk tolerance change. The market's dynamic. Okay, just because you're bullish yesterday doesn't mean you're going to be bullish tomorrow, or vice versa. Okay, so you're certainly free to change your strategy or manage the position if something happens. But ideally, this is how this strategy works. You know, you're technically you're buying low with the cash secured put, and ideally selling higher with the covered call, rinsing and repeating and doing the strategy over and over again, and ideally creating an income stream while also, you know, getting into a position that you don't mind owning in the first place. Okay, so once again, a cash secured put is a two-part strategy. It involves a short put and cash to cover, to monetize or securitize any potential assignment obligation. Typically, anybody who puts on a cash secured put is neutral to moderately bullish. Okay, if you were really bearish, you're probably not going to look to do a cash secured put, because that would be like trying to catch a falling knife. If you really think the shares are going to fall apart, doing a cash secured put probably isn't the right strategy, unless, of course, you want to buy shares at that particular strike and you're okay with that. As the strategy involves a short put, the investor must be willing to buy shares at the short strike price in the event of assignment, regardless of how low shares can go. Your ultimate risk in any cash secured put position is in that potential long stock position from a potential assignment. Once again, upon assignment, the investor becomes long stock, along with all the risks associated with being long stock. And if you get assigned on that cash secured put, you can create additional income by selling a covered call against that long stock position. Once again, this is called the wheel strategy. So it really is it's a hybrid position. It's a combination of a cash secured put, should you get assigned, then turning that position into a covered call. So I know that was a lot. This is a screen of our information. Here's our website. For more information regarding our educational offering, you can go to optionseducation.org. We also have a YouTube channel where we archive many of our past webinars. So if you have a interest in learning more about various aspects of implied volatility, or credit spreads, or butterflies, or condors, anything, we have done multiple videos on all kinds of different topics, and you can archive those on our YouTube channel. You can also follow us on Facebook and X. And if you ever have questions, once again, you can shoot us emails at options@theocc.com Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time. We actually just rolled out a new program. So we give we give 2 webinars a month live. It's every second and third Wednesday. We actually have one tomorrow where I believe my colleague Mark Bensequin is going to be talking about credit spreads. So if you have interest in that, you can sign up for that. That happens at 3 p.m. or 3:30 p.m. Central Standard Time. It's an hour-long webinar. But following those webinars, every second and third Thursday at noon Central Time, we just introduced a new program called Office Hours. And Office Hours is anywhere from 30 minutes to 45 minutes, where we entertain questions live from all the people that have questions about options. So it's usually 2 instructors. They field questions live and answer them in a live format, exchanging a dialogue back and forth. It's a new program we just rolled out. We're really excited about it. And people have been asking about, kind of an interactive forum where they can ask questions, hear what other people are asking in terms of questions, and getting answers from a live instructor. So I know that was a lot. I'm going to bring back Natalie and see if we have any more Q&A, but thank you for attending today, and we really appreciate you taking time out of your busy schedule to be with us.
Yeah, thanks so much, Ken. Same right back at you for taking the time to put this presentation together. We do have a couple of questions, so
Sure.
I'll ask you to keep your screen live just in case you need to go back over anything. We got a question from Mike asking about if you can discuss how to manage a trade when it goes against you. You did touch on this with assignments, just throwing it out there in case there's anything else that you want to touch on with that
Yeah,
question.
so once again, managing the position. Sometimes you put on a cash secured put. Like I said, you sell the 90 level put, so stock's trading 100 because you really want to buy shares at 90, and all of a sudden, the stock falls apart, and now it's trading 80. Okay, and all of a sudden you're thinking, oh God, do I really want to buy shares at 90 now because it's trading 80? Maybe I'm not as bullish. Maybe some news came out that affected my forecast. Sometimes the best thing to do is, you could buy back that short put. Yes, it's going to be a realized loss, but you're not going to take on potentially as much loss should you get a sign on that put and be long the shares. Okay. Um, there are things that you can do. You know, Obviously, options are never set it and forget it strategies. They do require constant monitoring because there's all kinds of different aspects that impact an options price, including implied volatility, time decay, uh, news events, stock movement. There's a multitude of different things that affect an options price. And For whatever reason, sometimes, the market throws you curveballs, and your forecast changes. So, once again, there's no textbook way to manage a particular position. You just have to kind of reevaluate on a daily basis, kind of ask yourself, are you still as bullish as you were yesterday? Are you still as bearish? Are you still neutral? Sometimes if that's the case, then maybe you just do nothing. Um, you could also, buy back that put at a loss and sell a lower strike put against it, taking in additional premium income to offset that loss. That's also a strategy you could do. If you're short the 90 level put and stock breaks 90, maybe you don't want to buy shares at 90. You could maybe buy back that 90 level put. Yes, you're going to take on a small loss, but maybe sell the 85 level put or 80 level put, rolling that strike down and potentially buying shares even lower. So, I hope that answered your question. I know there's no really perfect answer when it comes to managing a position, and it's really going to depend on the individual and their forecast and risk tolerance.
Yeah, that makes sense. Thanks, Ken. That kind of dovetails into another question we got
Yeah.
asking about what the thought process should be when you're trying to make that position, whether you're going to roll or let it get assigned. So you just answered that. So thank you for that.
Yeah, and
Um,
typically the reason why somebody rolls, like if you're coming to expiration and you're right at your short strike, and this is where somebody might roll is they really have no idea if they're going to get a sign until you're not really going to know until Monday morning, because technically,
mhm.
even though the stock, let's just say you're short the 90 level put and the stock closed at $91 and you do nothing and you think, oh, I'm just going to keep this premium and I'll wake up on Monday morning and I'll sell another put against it. You could still technically be assigned on that put because even though the stock closed on expiration at Friday, okay, the market still trades in the aftermarket. And if some bearish news came out, and let's just say in the next half an hour, some bad news came out and the stock dropped to 85, you could still technically get assigned on that 90 level put. So, at expiration, many traders will cover their short strike risk regardless, so to mitigate against an unwanted assignment should stuff happen, because it doesn't happen a ton, but markets do move in the aftermarket, and just because the stock closed at above your strike price at expiration in the case of a cash secured put doesn't mean that you're free and clear of a potential assignment. So for our OCC member firms, we require that they get their exercise notices into the exchanges by 90 minutes after the New York Stock Exchange close. So, there is a window there where technically you could be assigned. Okay. So, some brokers have exercise cutoff thresholds as little as 10 or 15 minutes after the close. So it varies between brokers, but if you just let that put expire or a call expire, just know that you still have assignment risk for, a short window, even though it appears that that stock potentially closed, out of the, or that option closed out of the money and worthless.
Got it. Okay, thank you. Another question we got was, and this might be one of those scenarios where you don't have an exact answer here, but Chuck is asking, what deltas are a good range to sell the short put?
Okay, well, delta is kind of like another way to look at delta is the probability of your option finishing in the money. So, if I sell a 50 delta option, in other words, an at the money option, that some traders will view that as that option has a 50% chance of finishing in the money. Okay. Obviously, as you go down, more out of the money puts have smaller deltas. Okay. A 90 level put might have a 25 delta. Okay. That means that, some traders will view that as a 25% chance of finishing in the money. Okay. Well, if it has a 25%, I'm sorry, 25% chance of finishing in the money. Well, if it has a 25% chance of finishing in the money, it likewise has a 75% chance of finishing out of the money, right? Because at expiration, there's only two scenarios. Either it's in the money or it's not. Also, don't confuse an option finishing in the money, the percentage that the option could finish in the money with how profitable that option could be. I mean, you could sell, you could own a 100 level put, the stock, if you paid $5 for it and the stock closes at, $99.50, technically that put is 50 cents in the money. It's going to finish in the money. But if you paid $5 for it, you're still gonna lose $4.50. It's gonna be a losing trade for you. So some traders will target strikes based on the delta of the option, but I think you really have to kind of ask yourself what, in terms of the cash secured put, once again, what strike, if you're using cash secured puts as a way to leg into a position, what strikes are you comfortable buying those shares at? Some people will use technical analysis to figure out like, where's support on the stock or, long term, like where's the stock could it go? They'll use things like that to kind of figure out what strikes to target. The more you're taking in premium, obviously, there's going to be a little more risk there, either from a strike perspective. And in the money put obviously has a higher chance of getting a sign, but you're taking in more premium. But when you sell options, there's two components of an options price. If it's in the money, it has intrinsic value and extrinsic value. Anytime you sell an option, it's only the extrinsic value that decays on a daily basis, not the intrinsic portion. So basically, in the money options have both intrinsic and extrinsic value. At the money and out of the money options have 100% extrinsic value. And it's that extrinsic value that traders are typically trying to capture when they're selling options. So that's also kind of something to keep in mind. So if you sell an in the money put, keep in mind it's going to have both intrinsic and extrinsic value. But for that put to expire worthless, you're going to need a big rally in the shares because it's going to have a high delta. If you sell the 110 put with the stock trading 100, it's going to have $10 of intrinsic value. Maybe it has $2 of time premium. You're going to take in $12. But for that put to expire worthless, you're going to have that stock rally $10 between now and expiration. That may happen, but if it doesn't, you're effectively going to be long shares from 98, right? It's that time premium, the extrinsic value of the option that really matters. Okay, so I hope that helps.
Okay, yeah, no, definitely. And we're unfortunately right up against our time frame here. There are a couple of other questions kind of getting a little bit in the weeds though. So
Yeah.
I want to ask, would the best place for these fine folks to email their questions be this options at theocc.com, or is there a different specific?
No, you can actually use this
thought?
email to
Okay.
address. Just send your questions to this. It'll come directly to my inbox. You can, if you have a question, I'll get it tomorrow morning, and I'd be happy to answer any and all questions that you still have.
Wonderful. Thank you, Ken. Yeah, so that's just a reminder for those questions we were unable to get to. Please send them via email to Ken at options@vocc.com. And if anyone has, specific questions or they misplaced that address, that's fine. You can send them to us over here at info@TradeAGT and I'll get them over to Ken.
Right.
So
And if
no
you ever
worries
have
there.
questions, just if it doesn't have to necessarily be about this webinar, if you ever, I don't know, a month from now have a question about a particular option strategy or something, happened and you're wondering about it, like you can always send us emails and we answer emails all the time about different strategies and options theory, like I said before, how a corporate action can impact your options position. So
Right.
yeah, so absolutely.
Yeah, that's great. Thank you very much for providing that. It's definitely continues to be in good use and we'll get a lot of use out of it moving forward. So we appreciate it.
Well, you're
We
very
are
welcome.
going to have to close up tonight though. Ken, a pleasure as always. I look forward to having you back at another educational webinar. We will have Ken back. Don't worry, everyone. He always puts on great presentations. And thank you to everyone who took time out of their schedules to join us live and for asking all these great questions. Really good engagement. Love to see it. Please keep it up. And we wish everyone good trading, and we'll see you back at another Avant-Garde webinar soon. Thanks, everybody. Thanks, Ken.
You're welcome, Natalie. Thank you, so everyone.